Good morning, Camo, and welcome to All About Finance 2. We've got a great session planned for you today. Last month, if you remember, you had a chance to hear about general finance information as it relates to savings, retirement, getting out of debt, and much more. Today, our session will be more specific to AT&T benefits. There will be some really helpful information shared and some benefits that you may or may not know that you have. So without further ado, get your notepad ready or get your keyboard ready because there's going to be a lot of information shared. So be sure to take notes. And without further ado, I'll hand it over to our moderator, Sheila Simmons.
Good morning, Camo. I am so excited to join you this morning and host session 2 of All About Finance. Our topic today is going to be everything 401k. I remember when I joined the company almost 16 years ago, I had no clue about 401k and the benefits that it held. Today, we have a very special guest joining us, Miss Ellen Anderson. Miss Ellen has over 10 plus years of experience working on 401k and pension and retirement benefits. She is currently the program manager for AT&T's Your Money Matters, and she holds a bachelor's degree in business administration. So please allow me to extend a warm Camo welcome to Ellen Anderson. Good morning, Ellen.
Hi, thank you all for having me. Well, we do have a lot to cover today, so I'm going to start sharing and we will jump right in. Today's presentation, it's the basics of your 401k and beyond. So as Sheila mentioned, I manage the Your Money Matters program here at AT&T, and that program is in place to help you all make the most out of your AT&T money benefits. And you can't really make the most out of your benefits if you don't know what they are. So hopefully today I'll be able to share some things about your 401k plan and some other money benefits that you might not have known before, and provide some clarification on items that I've found over the times of that I give this presentation that cause some confusion and questions for people. So just to get started, I am an employee here at AT&T, just like you guys. I am not a financial advisor. The topics here are educational in nature, and AT&T does not provide legal, investment, financial, or tax advice. Frankly, you don't want my advice, but I can give you education on your AT&T benefits. So let's jump into it. So just to level set, we're talking about your AT&T retirement savings plan predominantly today. That's your 401k plan. And Fidelity is the administrator of our 401k plan. This is how you can access Fidelity, their 800 number, and their website, netbenefits.com/ATT. Really, to get started, a 401k plan is an employer savings plan. So it allows people to set aside money out of their paycheck toward their retirement. And it is provided by an employer under the IRS, or the Internal Revenue Code, the IRC, in section 401k. So that's why it's called a 401k plan. You might also hear about IRAs. IRAs are individual retirement plans, and the difference there is that an employer like AT&T can't offer an individual retirement plan. You have to go to a financial institution and open one of those yourself. So similar rules in an IRA and a 401k, not all the same, like your compensation, your how much you're allowed to save, those will differ. We're going to focus on a 401k today, but I just want to make sure everyone knows that just means retirement savings plan offered by a company to its employees. Most retirement savings plans, most 401ks will offer a company match, and AT&T does as well. So most AT&T employees can maximize their company match with a 6% contribution on every paycheck of the year. And I'll explain why it's important to contribute on every paycheck of the year. There is a 1-year service requirement to start receiving the company match unless noted otherwise. And the match is a bargain benefit. So you would need to reference your summary plan description, which is a summary of the rules of the plan, the 401k plan. You can find that on netbenefits.com and /ATT, and then you can look at your summary plan descriptions. But an easier way to find what your specific company matches is to log in, and this link will take you directly to the page, to your contribution page, hit contributions, and then this little bubble here that says consider this explains what your company matches specific to you. So when you log into your account, you don't have to worry about personalizing it. It's already personalized to you, what your match is. There's also a requirement for 3 years of service where you have to work at AT&T for 3 years in order to keep the match money that you're receiving. And it's not a rolling 3 years. It's just once you've been here for 3 years, you get to keep everything you've received and everything you will get in the future from AT&T. The money that you put in, you take out of your paycheck, you put in your 401k account, you invest it, and it grows and grows and grows, hopefully, till you retire. That money that you put in is always yours to keep. So you don't have to worry about losing that if you leave AT&T and go to another employer. So important information here, why you should be contributing on every check of the year. So we've got 2 people, one on our left and one on our right. They make the same amount of money and they actually end up contributing the same amount through the year. On our left-hand side, we've got someone who contributes 6% on every check of the year, never takes a break. On our right-hand side, we've got someone who contributes 12% of their pay, eligible compensation, but only for half the year. They both ended up contributing $2,700. But on the left-hand side, they made double the match from the company because the match is actually calculated on every check. We don't look at your pay for the full year and then do the calculation of the match. We match you every time you put money in. So we don't go back and then give you more. So that's why it's important to not take any breaks when you're contributing to your 401k. And if you want to go in and see how much you're contributing, that screen on the previous slide here, this link will take you right there. But if you want to log in to netbenefits.com, use the 401k quick links and drop down to contributions and then go to contribution amount. And you can see as long as your contributions total to at least 6%, you'll be maximizing the company match. Now let's talk about what kinds of contributions you can make, because when you go to that contribution screen, you're going to see a laundry list of different types of money that you can put into the account. And that gets a little confusing, so let's talk about it. You can contribute before tax, Roth, and after tax, and all of these are eligible for a match. So you can kind of mix and match. Now, just to be careful, because I know we have a very variety kind of backgrounds of employment history on the phone. Roth, after tax, and catch-up contributions are bargain benefits. So you'll want to review your summary plan description to see if that applies to you. Also, when you log in, if one of these benefits doesn't, or one of these types of contributions isn't available to you, you just won't see it. And I'll talk a little bit about an example for everyone. So before tax contributions, that's what you traditionally think of as a 401k benefit. You put money in from your paycheck before you pay taxes on it. It lowers your taxable income today. But when you take the money out of your 401k plan in retirement, you pay taxes on how much you put in and then any of the growth, any of the earnings, because you're investing it when it's in your 401k plan. Roth contributions kind of work in an opposite way. Roth contributions are taxed today. And then when you take the money out, since you've already paid taxes on your contributions, you don't pay taxes on what you put in, And as long as you are at least age 59 and a half and your first Roth contribution was at least 5 years ago, you don't pay any taxes on the growth. So that's a really great source of tax-free income in retirement that you can set up for yourself. Every time I say Roth, people think I'm talking about a Roth IRA. I'm not. This is still your 401k. This is an option for you to save Roth type of money, which is an after-tax type of money that allows you to earn income on that money that will not be taxed in retirement if you meet that criteria of being 59 and a half and starting at least 5 years ago. And that is still available to you in your 401k. Let's give an example of how this, the different, if you earn, let's say you earn $50,000 and you contribute $5,000, just to work with round numbers. If you're contributing $5,000 with before tax money, then you are being taxed at $45,000 this year today, okay? If you're contributing $5,000 in Roth money, then you are going to be taxed at $50,000 today. So you're saving your tax break for retirement if you contribute Roth money, and you're getting your tax break today if you're contributing before tax money. That makes sense? Okay. So the next type of contributions that you can make are after tax, and after tax contributions are similar to Roth in that you're paying your taxes today, but your earnings are still taxable with the after tax type of money. So what we normally see is people maxing out their contributions to before tax and Roth before they think about after tax. And like I said, all types of these contributions are matched, but matching contributions are treated like before tax because you've never paid taxes on them and neither has the company. So limits, you can contribute up to $19,500 in 2021 between before tax and Roth. That's why people take advantage of it first, because it has a lower limit. Now this is a much higher limit than you can contribute in an IRA, but it's still lower than the overall limit. Once you add together before tax plus Roth plus after tax plus what you get from the company in match, that is $58,000. So that you can put in your 401k. We don't have a lot of people that worry about that. We don't have a lot of people that need to worry about putting $58,000 into their 401k, but if you do, that's the limit. Lastly, in addition to all these types of money, if you are age 50 or older and eligible for catch-up contributions, then you can put an additional $6,500 into your 401k if you're age 50 or older. And if you are not age 50 or older in 2021, when you log into the Net Benefits website, you just won't see it. You won't see that contribution type. So that's what I meant when I said, when you log in, you'll see what you're eligible for. The $290,000 that's on the screen here, that's if your compensation, your eligible compensation that you earn in the year reaches that number, then you cannot continue to contribute to your 401k. Everything before that is eligible, but everything after that is not eligible to be deferred into your 401k. So these slides, I just like to show that starting early is very important. Every dollar that you put in your 401k when you're 25 has 20 more years that it can grow compared to the dollars that you're putting in when you're 45, or 10 more years than when you start at your 35. So definitely starting early, super important, and maximizing your match, super important. Contributing 3% and getting that company match, not as powerful as contributing 6%. The company match, a lot of people say it's free money. It's not just free money, it's part of your total compensation. It's part of the money that AT&T is paying you to work here. And we are not volunteers here, we are workers. So make sure you're getting all the money that AT&T is giving you. It's part of your total compensation package. So here's the things that I think people might not know about their 401k plan that we provide. Annual increase program. Many of us are eligible to log into our 401k and opt in advance to increase our 401k contributions from the before tax contributions at least one time a year. So you can set it up. So I heard somebody tell me that she sets it up to increase 1% on April Fool's Day every year. So it's kind of a little joke on herself where she's seeing maybe a little less come out of her paycheck, but it's so slight you maybe don't notice. But she sets it up on April Fool's Day. So she's doing something good for herself but also playing a little prank on herself at the same time. I like mine to set up on my birthday. So every birthday I put a little bit more into my 401k. So you can go in same place that you would go to change the amount that you're contributing. You just click on annual increase program and set it up so that you don't have to remember annually to go in and change your contribution. And that way, kind of as long as your compensation hopefully is increasing over the years, you're still continuing to put more into your 401k over the years, and therefore giving yourself that little bit more in retirement. Rebalancing. At some point, you chose how you are investing in your 401k. And maybe you didn't choose. Maybe you were defaulted into one of our age-based funds. That's one of the funds that has the year in the title, the investment that says 2040 or 2045, 2050. You're choosing in that case the year that you think you're going to retire. And as a default, they're going to choose the year that's closest to when you turn 65. But if you think you're going to retire when you're 55, then you might want to change that to the year that you choose, the one that you turn 55. But over time, some investments are going to perform better than others. And rebalancing means selling the fund that is performing very well and buying the fund that is not performing as well. And you're thinking, why would I want to do that? That doesn't make sense. But you don't want to be more aggressive in terms of being in a more volatile fund, one that has performed really well unexpectedly and not being as safe as is comfortable for you. So rebalancing means going back to my comfort zone and what is appropriate risk for me and when I want to retire. And if you don't know what that appropriate safe zone is for you, what you're comfortable with, I have a way that you can figure that out. We'll talk about that next. With a rollover, if you have an old 401k plan from a former employer, it can be a 401k, a 403b if you were working for a nonprofit, you can move that money into your AT&T savings plan. You don't have to. Obviously, you can keep it where it is in most cases, as long as that former employer allows you to keep it where it is. But that moving them all together allows you to simplify your retirement savings. And you just want to compare the fees before you make a move and make sure that the investments that you have available to you are in each plan are what you want. But it is easier to manage one login, one password, rather than many logins, many passwords, many websites. You never want that money to get lost on you. That's super important. We have a lot of people, there's over 300,000 people who have their accounts with the AT&T 401k plan, right? But they don't all know they have an account with the AT&T 401k plan. They might have forgotten about it. They might have opened it when they were working here when they were 22, and now they're in their 40s and work somewhere else and have completely forgotten about this plan. Don't let your money get lost on you. It's your money. So if you're not going to move all of your money into one 401k account here at AT&T, at least make sure you know where your money is, that you know all those websites, that you know your logins, and that your information with that company is up to date. Okay, make sure they know where your address is and your email, and that way you'll get all the information about that plan if they change anything. You know, if they move to, if maybe they're with Prudential and they're going to move their plan to Fidelity, how would you know if they don't know where you are? So make sure your contact information is up to date. Spillover. This is for our super duper savers. And if you want to hear more about Spillover, this little icon, when you get the slides, will take you to a video. But if you exceed that $19,500 between before tax and Roth, then your money will spill over to the after tax type of money. This allows you to continue to get company match. And I have, I can show an example if anyone has questions about that, but I think I took it out of the slide because we're trying to get through a lot of information here. So if you put in more than $19,500 between before tax and Roth before the end of the year, then you can start contributing after tax money, go above that $19,500 and continue to get your company match, because after tax money is also eligible for match. And like we talked about before, you don't want to miss any paychecks when you're contributing. So if you're wondering how to choose your investments in your 401k, and maybe that's not something you're comfortable with, we've got Edelman Financial Engines as our 401k investment advice provider. You can access Edelman Financial Engines either by edelmanfinancialengines.com/4ATT, or you can access them directly through Net Benefits. Now, they are not affiliated with Fidelity, but because they do the investment advice for our 401k, you can access them through your Net Benefits account. Edelman Financial Engines has 2 levels of service. They've got online advice, which is completely free to anyone with a 401k account. And they've got professional management, where you pay someone to manage your 401k account for you. So with online advice, that's just for the do-it-yourselfer. I want to manage my own money. You can use their planning tools. I suggest that you log in, that you personalize everything, tell them how old you are, when you want to retire, how much you've saved, if you're married, and they'll ask you what your risk tolerance is. They'll give you a couple questions to help you figure out how risky you want to be with your money and how comfortable you are with risk. And then they'll tell you exactly where to invest. 12% in that fund, 13% in that fund. They'll tell you where to put your money. And then you can check in quarterly and make changes. You have to go back to Fidelity to make those changes because you're doing it yourself, but you'll have the map of where exactly you should put your money available to you. Or if you are like, I don't know, not for me, I'm not managing my own 401k, I will pay someone to do that for me. They please and thank you. Here you go. Then you can sign up for professional management. And that will cost you about $1.40 a month, $1.42 a month per every $10,000 you have in the account. And it is charged quarterly, and it's taken right out of your 401k account balance. Right now, sneak peek, there is a special offer going on with Edelman Financial Engines that you can sign up and get your account professionally managed for 3 months for free. And then if you want to stick with the service, you can stick with it and then the fees will start applying after November, or in November. So if you want to sign up now, go to this website, edelmanfinancialengines.com/4ATT, and you can sign up and have your account professionally managed for 3 months for free. And also this link here on the screen, schedule an appointment. You can schedule an appointment following this presentation to speak with an Edelman Financial Engines advisor. They can talk to you about all sorts of personal finance things. Now, their specialty is, of course, investing in the 401k, but they are professionals in personal finance, so they can talk to you about a lot of different questions you have. Maybe you're thinking, should I do before tax or Roth? They can help you talk through the consequences of doing that and the benefits, pros and cons, and that sort of thing. Planning tools and resources. Within Fidelity, obviously they are a giant financial firm, and they've got tons and tons of resources. So you can go to the Planning and Guidance Center and monitor your financial goals. You can get tools and resources in the library, and they have webcasts available and recorded out here as well. And it's not just about 401k, it's about all personal finance stuff. So takeaways, review your 401k contributions, see if you want to make an increase, access Edelman financial engines. We've got a whole video series about the AT&T retirement savings plan. And if you want, you can join and follow our T-Space community. It's currently active and has a lot of discussions going on about personal finance. So that is what I wanted to share about 401k, but we do have more information to come, and then we'll have questions at the end. So I will jump in and keep going. We're going to talk a little bit about the difference between a health savings account and a flexible spending account. Health savings accounts and flexible spending accounts are health related. They both allow you to put before tax contributions aside to be spent on qualified health expenses. But they are different because they have different eligibility criteria and they have different rules associated. So with a health savings account, you need to be in a high deductible health plan. That high deductible health plan, I believe in 2021, has a deductible that's over $1,350, I think $1,350. Then if you have a health plan that has that high of a deductible, then in most cases that will be eligible for a health savings account. Health savings accounts carry over from year to year, so you don't have to use the balance by the end of the year. You can enroll or make changes to your contributions at any time. It's a personal account, so you can take it with you, and you have the option to invest your balance. Flexible spending accounts are more open. They're eligible really to anybody who is enrolled with an AT&T health plan. It doesn't have to be a high deductible plan. And the full contribution amount is available at the beginning of the year. It's not what you're you start with how much you're committing to put into that account, and then you can use that balance down, and you're still putting money in throughout the year. You do need to use it by the end of the year though. And there's some wiggle room, but I won't go into that kind of level of detail. Just know that you need to use the money by the end of the year. So you don't want to commit to putting more money into the flexible spending account than you think you're going to actually use. These are what the qualified medical expenses, these are just examples. They are defined by the IRS, not by AT&T. So just as an example, a wheelchair is included, nutritional supplements not included. I talked a little bit about the eligibility, but here's the eligibility for all the different kinds. Let's talk about that there are different kinds of flexible spending accounts. A healthcare flexible spending account, that's the most similar to a health savings account in that the qualified expenses can be used for medical, dental, vision, and prescription expenses. If you have a health savings account, you can also have a limited flexible spending account for dental and vision expenses. And it's important that if you do have a health savings account, you only use a flexible spending account for dental and vision. Your health savings account would be used for medical expenses. And dependent care flexible spending account, these are for qualified expenses related to child or elder care. There are a lot of criteria around this type of account. So it's very important that you know that you meet all the criteria. You need to be using the money to care for somebody in order for you to be able to work. So, but there's more to it than that. And it, of course, all the rules are defined by the IRS, not by AT&T, but that is available to you. And one thing to note, that the limits for the dependent care flexible spending account actually just recently increased. If you are participating in a dependent care flexible spending account here at AT&T, you would have received an email actually like last week or the week before notifying you about changes to the dependent care flexible spending account limit and how to make a change if you want. Okay, so moving on, time check, I think we're doing good. Will preparation and beneficiaries. If you are signed up for supplemental life insurance through MetLife here at AT&T, then you can sign up for will preparation for free. So there is a service that would give you a will with no tax planning, a power of attorney, and a living will. And you just give MetLife a call. You can use these FAQs, and these are clickable. All the other information about this service is actually still out on T-Space. So if you go out on T-Space to the Your Money Matters community and search the word MetLife, you'll find a lot of information about this service, about testimonials from employees who have used it and been happy with it. And basically the way it works is that there's a network of attorneys who are enrolled in this program. You would call MetLife, you'll tell them that you work for AT&T, and you'll tell them your zip code. They will give you a short list of attorneys in your area that are participating in this service, and then you can call those attorneys and speak with them about what kind of forms you're looking for your estate planning needs, and then you can decide which attorney to work with, and they will do these documents for free. But then if you want to kind of go above and beyond these, then you would be paying out of pocket for that. So for example, a trust is not included, but a will is. So definitely a nice service. I mean, some of the people on T-Space said that they got, like, I think up to $1,000 or more than $1,000 worth of free work done for them using this service, because the attorney will tell you this is what it would have cost you if you didn't have this service. They also have estate resolution services, which helps your beneficiaries through the process of probate for you or your partner's estate. And beneficiaries for your life insurance, 401k, and pension. This means in the event that you pass away, who would receive this money? You can name all of that on netbenefits.com/ATT. And because your health savings account, if you have one, is an individual account, you name that separately on the fidelity.com website. But do make sure that these are named. And I've gotten the question before, what happens if they're not? There is a default system in place as to, you know, who would receive the money in the event that you don't have a beneficiary named. And the problem with that is, so it doesn't mean that no one will receive the money. It just will take that much longer. You know, we have to figure out who is your spouse, right? There's nowhere in your 401k plan, if you don't tell us who your spouse is, that we don't know who your spouse is, right? So you got to say. So there's no way to contact people if you don't give that information. So it just ends up taking longer for your family. So definitely make sure you have these records on file. And sorry to be so morbid, but you know, we only have about 50% of our employees who have named their 401k beneficiary as an example. So definitely there's room for improvement on that number. And Castlight, take charge with Castlight. Castlight is our well-being app. It allows you to set health goals. You can find all information about all your different kinds of health and well-being benefits on Castlight. You can receive points for tracking your activities. You can receive points for learning about your benefits. And it's just a nice kind of all in one place. And there's actually a challenge going on in Castlight right now, a health challenge. Go walking with your friends and earn points for doing that. So I definitely recommend going out to Castlight and logging in, downloading it. Sorry. Okay, got through it quickly. So we can start with questions. So Sheila, if you want to open it for questions.
Absolutely. So it does look like we have a few questions out there. So first we will start with Jonelle. It looks like Jonelle has two questions around company matches and the rebalance option. So Jonelle, if you can come off of mute and ask your question.
Can you hear me?
Yeah.
We can.
Okay, I gotta go back. I don't know which one to ask first. So the first question I had was, do you recommend putting in more than what the company matches?
Well, my question back to you would be, do you want more money in retirement? So yes, I would definitely. So the rule of thumb that Fidelity has kind of given for us is 15% of your eligible compensation or your compensation should go towards retirement. And that can include the company match. So just to work again with, let's just work with round numbers. Let's say you're getting 6% from the company, then you're going to want to put at least 9% from yourself in order to get to that 15% of company match. But
So,
I mean,
I might follow up on that because, I mean, I've invested, my full 14 years I've been with the company.
right?
And I have, I've only ever done up to the 6, but, my tax lady, she recommends before tax, but after hearing you talk today, I almost feel like I need to be planning more for a long term and paying the taxes on it now, considering me and my husband, both of our incomes and stuff like that. So
well, you can do both. You could do a portion towards before tax and a portion towards Roth. And as long as you are going to be, you have at least 5 years until you're retiring or till you're going to use the money, then you can definitely take advantage of Roth if you do that.
And the company still matches both. So even if I did 5% and 5%.
Exactly.
And then that's going to help when I retire. I won't get hit as much on taxes, but I would still be paying some taxes on the amount that I didn't pay taxes on before retirement.
You got it. Mm-hmm.
Oh, my brain is working.
All right, so it looks like our next question is from Jason Voss. Jason has questions about switching contribution types. Jason, if you can come off of mute and ask your question, please.
Double muted. Can you hear me now?
We can.
Oh, man. All right. A couple of Arkansas folks. We're trying to learn here, okay? First off, thank you so much for getting on here and sharing all this knowledge. I am very unknowledgeable about this stuff, but this is awesome. Can we change, like, from Roth to before tax or whenever we want? Like, I think I just checked. I was doing before tax, and like Janelle, I didn't really pay attention. I'd like to probably switch to Roth. Can I do that right now?
Yeah, you can change. So one thing that's interesting about 401k that's kind of different about the rest of our benefits, it's not tied to annual enrollment. And actually at AT&T, we don't have rules on how often you can go in and make changes. So you can make changes to how much you're contributing, what type of contribution you're making, and you can make changes to your investments every paycheck if you want. So that's definitely an option. And yes, you can make changes between before tax and Roth, switch them, do both, whatever. And the only thing I'll say is that it might take a couple paychecks, depending on exactly when you do it in the paycheck cycle. It might take 2 paychecks before you see the change, but you can make the change and it'll go into effect just as soon as administratively possible.
Perfect. And that'll, I guess, it's just like, it's one account, right? So like the total amount I have, that would just flip over to a Roth, right?
It won't, not the total amount you have will flip to Roth. So you'll have buckets of money. I call it buckets of money.
Okay.
Fidelity is more formal and they call it sources of money. But if you're in your net benefits account, you can go and look at you can view by source. And that will show you like company match is its own bucket of money, before tax is its own bucket of money, Roth would be its own bucket of money. And just for clarification purposes, since we're talking about it, we used to have in the AT&T retirement savings plan, we used to have basic and supplemental. And basic contributions were the contributions that were eligible for match, and supplemental were the contributions that were eligible for you to put in but not match eligible. And we changed that because it was confusing people. So we just have one bucket now. But if you were contributing back when we had basic and supplemental, you're still going to see that in there. It just, the supplemental bucket is not having any more money put into it from your paycheck anymore. It's just everything's going into the basic bucket. And now just the first 6% that you put in is eligible for the company match. And it sounds confusing now that I'm saying it out loud, but we did this for simplification purposes.
Thank you.
Mm-hmm.
All right, so it looks like we have another question out there. Laura Ozark has a question about cashing out and borrowing against 401k. Laura, can you come off of mute and ask your question?
Absolutely, yes. Thank you for this, Ellen. This has been really awesome. I've got about 4 pages of notes here, so thank you. Yeah, essentially my question is it ever logistically, financially, all of the LEs appropriate to pull out cash? Or is this something I've always been told since I was like 5 years old, don't touch it, let it go, let it build. But I've heard some people do some really great things with pulling out their cash. So where are you at with that? What's your opinion on that, Ellen?
I think that money that you put into your 401k is meant for being used in retirement. I think that there are going to be extenuating circumstances, emergencies, and hardships, and times where people need money that are not retired, and they need to take a loan or they need to take a hardship withdrawal from their 401k. I don't think that there's any reason that you would take money out of your 401k and use it for other investment purposes. I don't see a scenario where that would be. I mean, I guess that scenario has never come onto been an option for me, but it just depends on your circumstances. I definitely think that there's probably going to be times for people where they need money, and their 401k is the place that they have money. But I don't know. I think not for another investment, but for an emergency, possibly that would be a good place.
Thank you. And I do have another surprise question. So my question is around pension. Yeah. So what is this? Is it equally vested like it is for our 401k? How do they differ? What is that? Because personally, I've noticed my pension does not move like my 401k does. So what is that differential?
Pensions and 401ks are super duper different. And everyone on the phone at this company, so hard to talk about pension because we all have a different employment history, and that leads to maybe having a pension, maybe not having a pension. If you have a bargain history, if you were hired on a certain date and you're a manager, if you are part of an acquired company like I am, we have 20 different pensions, and maybe only half of our employees have one. So if we have got half of our employees and they're all split into 20 something different pensions, you can imagine how complicated. But generally, a pension is a plan, it is a retirement plan, but it is one that only the employer contributes to. And if you have a pension plan at AT&T, you have a lower match than people who don't have a pension plan at AT&T. They have a higher match in their 401k because they don't have a pension plan. So that's why I couldn't say this is how much your match is on the 6%. I can just say you're going to get a match if you contribute up to 6%. A portion of that will be matched. And it's hard to say how much because I don't know if you have a pension or not. I digress. So a pension is a plan that only an employer contributes to. The employee cannot contribute to it. The only thing the employee can do is run estimates and see how much your pension will be. You are putting in, when you're running an estimate of your pension, you're putting in the last day that you work and the first day that you start receiving the benefit. And that will tell you how much you can anticipate receiving from a pension. It does still have the 3 years of vesting required, like the company's 401k match. So if you worked here for 3 years, you get to keep that pension money. If you have less than 3 years of service, you do not when you leave.
Okay, awesome. That answers a lot of questions for me. Thank you, Ellen.
And definitely give Fidelity a call to talk more about the pension if you have questions about it.
That was literally the plug I was going to put in there. There's this awesome digital assistant in our Fidelity app, even the Net Benefits app, that you can just ask those questions, and it's an immediate response. It's an AI technology, and it actually will send you to the part of the app that you were intending to find too. So that's my little shameless plug.
Another plug for their app, the Net Benefits app, if you are doing a rollover from an old 401k into your AT&T 401k, I've heard that doing it on the app is a much smoother process because you can take a picture with your phone of the required documents or even the check, and then less paperwork that way.
All right, it looks like we have another question from Jonelle. Jonelle, if you can come back off of mute and ask your second question.
Yes, mine is going back to the rebalance option that you spoke of. And just if you could just touch base on that a little bit more, because I mean, I guess I'm kind of understanding if you were to change your investment options and they became too risky, then it would automatically rebalance you back to what the company would choose, or?
So it's not automatic. So let's talk about, there's a difference between your investment elections and your account balance, where your money actually is. So let's say you have $10,000 in your 401k and your investment elections was 25% in 4 different funds, fund A, B, C, and D. So you would think you would have $2,500 in each of those funds, A, B, C, and D. But let's say fund A all of a sudden has $4,000 in it, and the other 3 funds have obviously a lot less than that. So the idea would be to sell fund A and put that money into the other 3 funds to make it more even, to bring them all back to $2,500, because you wanted there to be 25% in each. And fund A got to $4,000 because of how that fund was performing, not because of anything you did. You continued to put the same amount of money in that fund every paycheck because you've elected the 25%. So when I say rebalance, I mean that you go in to the Net Benefits website, you go to your investment tab, and you go to like change investments, something like, I don't think that there's a button that says rebalance, but the term is called rebalance. You just go in and you do an exchange. Fidelity calls it an exchange, where you sell fund A and you kind of move that into the other 3. I feel like if I had a script for that, that would have come out a lot smoother, but I hope that makes some sense.
Yes.
You do it, yeah, okay.
All right, guys. Well, we have no more questions left in chat, but we do have time for one final question. So if anyone would like to come off mute, we do have time for one last question. Well, it looks like there are no questions out there in the field. We do want to thank you so much, Ms. Ellen, for waking up with us and covering this awesome content with us this morning. I'm going to toss it back to Alyssa to close us out.
All right. So thank you, Ellen, again. Great information. It was great to see all the questions coming through. Sheila, thanks for moderating for us this morning. And for all the participants that were on, thank you for joining and really getting your questions out there. I hope the information was helpful. I was taking feverish notes, and really my takeaways are: take advantage of all the benefits the company has. Invest early. And for those of you that haven't been with us for 3 years, 3 years gets your investment vested, right? So it really ties back to tenure and longevity with the company. So any other questions you have, we'll get this deck out to you so you can see all the resources. You see the QR code here. We would love your feedback. So take a quick scan and share your thoughts with us. And thank you for the time, and hope it was beneficial. And we will see you all next time. Thank you.
Thank you.